Well, good afternoon, everyone. Cynthia Tomaine here with Interactive Brokers, and thank you for joining us today as we take a look at equity market volatility indexes. Now, with us today, I actually have Russell Rhoads. Russell is a CFA and a senior instructor with the Options Institute, the educational arm of the CBOE. He's also quite a prolific author, having several books that are currently out in print. One is on option spread trading. There's another that's also on trading fixed derivatives, and most recently is trading weekly options. So with that brief introduction, let me bring Russell on today, and I'm actually going to move over to his slides. Russell, if you could unmute your phone, I'm going to pass you the ball so that we can get started. Thanks for joining us, Russell, and welcome.
You bet. Thanks, Cynthia. Notice how quickly Cynthia gets away because I always try to chat with her before we get going. She's gone. So
no, I haven't unmuted yet.
I just wanted to mention, and I'm going to mention this at the end. When we put this presentation together, it was a few weeks ago, and I did not realize I was going to be doing this, but I'm actually doing a free class in Midtown Manhattan next Wednesday at the New York Hilton. So if you feel like coming down, please come down because I missed you at the last event that we were both at. But for everybody else, at the end of the presentation, I'll throw up there how you can find out about the free SPX/VIX class that I'm doing in 3 cities in the next 2 weeks. But for you specifically, Cynthia, I was inviting you to the one in New York.
Coming up, I got that email today, so I'll go back and take another look. Yes, thank you very much.
No problem at all. So I will talk to you shortly.
Well, I am still here. I'm just going to mute my phone so everyone can benefit from what you've got to tell us today. Thanks, Russell.
Thanks, Cynthia. So I appreciate the introduction. My name is Russell Rhoads. I'm an instructor here at the Options Institute at the CBOE. If you hear a little burst of noise behind me, that's because I'm within earshot of the VIX pit. And every once in a while when something erupts down there, you can actually hear a little bit of noise in my office. If it's a prolonged eruption and I've got nothing going on, I actually sometimes will go down there and see what's going on. Before we get going, just to make sure we're all on the same page, I am going to run through a trading example a little bit later, a little ways into the presentation. I'm here for education purposes only, and any suggestion or example that I show is for educational purposes only. I also leave the commission part out of the equation just because I'm more about the concepts and less about the math. I'm always rounding my numbers to nickels just so we can focus in on the concepts and not necessarily the math. Now, what I'm going to talk about today, I'm going to specifically talk about volatility indexes that are based on the S&P 500. Now, the most common one out there is the CBOE Volatility Index, which is commonly known as VIX. Well, we actually have 4 volatility indexes now that are based on S&P 500 index options. And I will start out talking about those 4. Then we also have fairly, robust Russell 2000 option market and NASDAQ 100 index option market, and through those option prices, we actually are able to calculate a Russell 2000 volatility index and a NASDAQ 100 volatility index. And those indexes actually behave a little bit differently than VIX. There are some differences in the composition of the indexes. I mean, they're all broad-based U.S. market indicators, but they do have their own unique characteristics. So we're going to talk about that a little bit as well. Now, VIX was the very first implied volatility related index. In fact, today, as I speak, is a milestone for VIX. We started trading VIX futures contracts 10 years ago today at the CBOE Futures Exchange. So they've actually been around for a full decade now. The Volatility Index, or VIX, has been around over 20 years. It's been around since 1993. In 2003, we reworked the VIX calculation to the methodology that we have now. And that methodology, or specifically for VIX, that methodology actually uses anywhere from 150 to 200 different index option pricing, and it just depends on where we are in the calendar and how volatile the market is. That has something to do with it as well. But in addition to VIX, we actually quote 3 other volatility indexes that use S&P 500 index options. And here is all 4 of them listed out, and including VIX. VXST, which is relatively new. VXST has been around for, it's been quoted live since the middle of the 4th quarter of last year. It was actually introduced on August 1st. It was August 1st, or I'm sorry, October 1st that we first introduced VXST. Yes, Sasha, just got a quick question asking, is change not also variance instead of volatility? It is, and we have variance contracts that trade over the counter, and actually we have variance futures, which is a realized volatility product that trade at the CBOE Futures Exchange as well. They measure market volatility in a little bit different way. Volatility or implied volatility is actually forward-looking, and it's coming from the option pricing, and that's what we're actually going to stick with today. But variance is actually a measure of market volatility as well. The ones that we actually that we most actively quote here at CBOE are the volatility indexes that get the implied volatility of S&P 500 index option prices and come up with a standard implied volatility measure for certain time periods, like the 4 that I've got right here. VXST is the CBOE short-term volatility index, which was introduced just a few months ago. We have weekly options on the S&P 500, and the CBOE short-term volatility index actually utilizes very short-dated SPX option contracts, and it gives us a consistent 9-day measure of implied volatility. The 3-month volatility index and the midterm volatility index use longer-dated SPX option contracts, and comes up with a 93-day measure and an 184-day measure of implied volatility, and these are consistent volatility measures. They also have their own characteristics as far as how much they actually move around. Just had a question, are we still on the title screen? No, we should actually be on slide number 6 now. Here is the activity in these 4 volatility indexes for 2013. And the blue line is VXST, which is that 9-day measure. And you can notice that VXST has lower lows and higher highs. It moves around a lot more. And keep that characteristic in mind, because I'll talk in just a couple of minutes about how you can now take advantage of that. VIX is the red line in there, and then the farther out we get, for lack of a better way to put it, these volatility indexes are less volatile. 9-day volatility is a lot more volatile than 30-day volatility. In fact, I will just to give you an example that happened recently. The week that we haven't come up with a cute title for it yet, but the week that the Ukrainian-Russian situation developed, VIX was up 26% that week, and VXST was actually up 62%. So that just gives you an idea of when we have some short-term short-term volatility events or short-term uncertainty, and I would say that there was a lot of uncertainty around what was happening with in Ukraine. Mainly, I think everybody was trying to assess what is the outcome going to be and how is it going to affect the markets. After we assessed that it wasn't going to have much of an impact on the markets, implied volatility seemed to come down very quickly as well. Here's VXST versus the S&P 500 last year. You can see that when we had small pullbacks in the S&P 500, and we never had more than, I believe, a 6% move pullback in the S&P 500 last year, we actually got some pretty significant moves out of VXST. You can see from mid-September to mid-October, we actually have VXST basically doubling. So that is, that just is another depiction of how VXST reacts to price action in the S&P 500. If I put a VIX chart up here at the same time, the shapes would look the same, the reactions would look the same, but the magnitudes to the upside and to the downside for VIX just are not as accentuated as the magnitude of moves out of VXST. Now, just taking a look at just to get that comparison, you can see that the shape is very much the same with VXST as we had with VXST. However, the scale is a little bit different. These spikes are not going up as much. And just to center in or focus in on that VIX-VXST relationship, you can really get a picture of it right here where we've got lower lows and higher highs. Now, the reason I'm focusing, we've got these 4 volatility indexes, but the reason I'm focusing in on the VXST and VIX is because we have futures contracts that trade on both VXST and VIX. And when Cynthia follows up, she'll actually show you how to look these things up on Interactive Brokers after I run through Russell 2000 and NASDAQ 100 volatility as well. But we have futures contracts on VXST. They actually expire each week. So every Wednesday, in fact, this morning we had a VXST expiration. Every Wednesday morning, which is 9 days before the following week's SPX expiration for either weeklies or standard options, we have a VXST settlement on the open. So VXST futures will trade through Tuesday's close and then will be settled on Wednesday's open. We will have 4 consecutive weeks trading as of tomorrow. We will continuously have a VXST expiration. The nice thing about this is if you are going to try to pinpoint some sort of, as I like to put it, volatility event, or maybe a Fed announcement, or you expect extra volatility during earnings season, you may take a look at VXST as opposed to trying to use VIX to benefit from what you think may be extra volatility. Right now we have VXST futures, and in just over 2 weeks, on April 10th, the intent is to launch VXST option contracts, which will also expire each week. And that is one of the topics that I'm going to be talking about when I go to New York, San Jose, and Chicago in the next few weeks to talk about SPX and VIX-related trading. Just a couple of more statistics to look at with respect to VXST. It is highly correlated to VIX. It has the same inverse relationship with SPX that we see when we take a look at VIX versus SPX. However, just looking at this numerically, the average realized volatility, and this was from 2011 to 2013, for VXST, it's close to 175%. For VIX, it was just under 110%. Yaroslav is asking, are any margin discounts for pair trading VXST versus VIX? I don't think that decision has been made yet. I think that's one of the things that comes out just before the options will be trading. In the futures market, I'm not 100% sure what the final decision has been as far as VXST versus VIX from and I believe the Options Industry Council, because we clear those 2 futures contracts, is the entity that takes a look at margin between those 2 contracts. And I know that there have been some discussions. I just don't know if there's been an outcome to those discussions or not yet. So the answer is maybe, and if there's not anything yet, just be patient. Maybe there will be something in the future. So, and shoot me an email, Yaroslav, and I'll see if I can ask the right people and get a more definite answer, because I know that there has been something in the works. I just don't know where it is related to VXST and VIX futures and any margin situation there. So great question, though. I say it's a great question because you're thinking about trading VIX versus VXST, which is exactly the approach that I have been thinking about, and I can't wait for VX for us to get a little bit more pricing and a little bit more liquidity in VXST futures so we can take a look at short-term volatility versus 30-day volatility and possibly doing some trades there. Just taking a look at VXST and VIX by year, we really only had, in the past 3 years, we really only had what I would define as one true volatility event, which was back in August of 2011. And that's when we got VXST going all the way up to 68 on a single day, while VIX, and I hate to use the word only, but VIX only went up to 48 on the, I believe, which was August 8th of 2011, which was a kind of a handful of factors that got the markets a little nervous. The correlation between VXST and the S&P 500, it's not as negative on a regular basis as the VIX S&P 500 correlation. I think there are times that VXST has a little bit more of an anticipatory nature to it. Again, when you might see institutions or individuals buying options when we're going into, the Fed announcement is one of the ones that I consider a good example. The employment number as well. So VIX has always been considered to be a very reactionary measure to what's going on in the S&P 500. I think VXST, what we've seen historically, and actually some of the things that I've already seen with the futures pricing, is starting to indicate that VXST may have a little bit more of an anticipatory component to it than VIX, but time will tell, especially as we're able to gather more data from the VXST futures trading. So just to give an idea of how much VXST actually moves around, I put together a term structure curve for 2013, and what I did was I took the average VXST, the average VIX, the average 3-month volatility index, and the average midterm or 184-day volatility index, and I got a pretty straight line there. You can see that this is the lowest close for each of these indexes in 2013, which was on August 2nd, and the highest close for VXST was on June 20th. You can see that short-term volatility definitely is more reactionary and probably got some anticipatory nature going on in there as well to what is going on or what is expected to go on in the overall equity market. And as we start to roll out VXST option contracts, I think one of the results will be an increase in volume for VXST futures. We really saw an increase in volume for VIX futures when we listed VIX options. So there are high expectations in the next couple of weeks that we'll have a tighter, more liquid VXST market than we have right now, and there will be some more opportunities there. VXST futures, as I've mentioned, we began trading futures on February 13th. We have weekly expirations, and it really does give you an opportunity to take advantage of expectations for a near-term volatility event, or you can always take a look at when you think volatility has gotten ahead of itself. You might want to consider taking the other side of a big move in VXST futures as well. So there's I didn't have the link on here, but I want to share the link. If you want to learn a little bit more about VXST and the different ways that you can trade it, there is the website or the microsite at the Chicago Board Options Exchange on VXST. So now on to one of my favorite indexes, the Russell 2000 Index. The CBOE Russell 2000 Volatility Index, the Russell 2000 by itself is often considered a benchmark for small cap stocks. However, it also can be considered a benchmark for the domestic U.S. economy. Well over 80%. In fact, I think it was 84% of revenues in 2012 for the Russell 2000 companies as a group actually came from within the United States. So If you think that the U.S. economy or the U.S. stocks are going to outperform global stocks, actually a strategy that you might consider is getting long exposure to the Russell 2000 and short exposure to the S&P 500. Well, if you think that the economy in the U.S. is going to be more, it's going to be a little bit rockier in 2014 relative to the rest of the world, you can actually take a look at volatility trading as well. We have futures contracts on RVX. RVX uses the same methodology as the CBOE Volatility Index. They are both 30-day measures. The big difference is the inputs for the RVX, or the Russell 2000 Volatility Index, would be pricing from Russell 2000 option contracts, while it's S&P 500 option contracts for VIX. Now, historically, the spread between the two has oscillated around kind of a an average that has held in place for some time. The average keeps moving, but they react the same to equity market moves, but they also kind of move relative to each other in kind of an oscillating type fashion. And they move relative to each other in ways that it is possible to consider getting short RVX and long VIX, or vice versa, depending on how they are trading relative to each other. One of the things that I have found over the past couple of years by watching RVX and watching VIX relative to each other is when we have some sort of geopolitical event like the recent situation in Ukraine, VIX tends to go up relative to RVX, or go up more than RVX. So sometimes when you get one of these geopolitical situations that really spooks the overall global economy, you see more of a reaction to the upside out of VIX than you do out of RVX, and you tend to see a reversion back to RVX being at more of a premium to VIX when whatever storm seems to have passed. That's one of the ways I like to take a look at RVX and RVX relative to VIX as well. We started trading futures on RVX in middle of November last year. They act just like VIX futures relative to the underlying. Sometimes they're at a discount. Most of the time the futures contracts are at some sort of a premium. They have a $1,000 multiplier. They have a $1,000 multiplier just like VIX futures contracts, and we can list up to 9 serial months. We typically have 4 months of RVX futures that are trading at any particular time. And the settlement date for RVX futures and options is actually the same as the expiration date for VIX, for VXN, and for a handful of other volatility products that we trade here at CBOE. It's 30 days before the following month's standard expiration date, or usually 30 days prior to the following month's third Friday. There are situations where sometimes we have a Friday holiday and settlement is on a Tuesday, which is actually what happened this month. That won't happen again for 4 or 5 years, I believe. This is, how I like to take a look at the Russell RVX futures versus the underlying index. And you can see that as we go farther out in time, more time to expiration, they tend to be at a premium, but the spread between the February and March contract here at 3/4 of a point, or 0.75, is narrower than when we get down here where we're at about $1.40 or so. The calendar spread trading with RVX futures makes sense just like it makes sense with VIX futures as well. So just another way that you can go about approaching RVX futures contracts. We also have options trading on RVX, and the RVX options, they began trading late last year, and there have been a handful of trades that have come in. We've had the open interest up around 1,000 or 2,000 contracts, depending on where we are within the calendar. The thing that you need to know about RVX options, not just that they are based on that they are settled based on the Russell Russell 2000 Volatility Index, but also that the better underlying pricing vehicle is typically the corresponding futures contract, just like VIX. And once we started trading these, the anticipation was that we would see that sort of pricing, and we definitely have. RVX options, they share the same characteristics as VIX, $100 multiplier, minimum strike prices of $1. We tend to only list the 3 near-term option contracts, and they always have futures that have a corresponding expiration, and they have that same sort of settlement date as well. Now, when you're taking a look at RVX options, and this is just a price that I just randomly pulled one day, you can see the Russell Volatility Index is trading at 1783, and the RVX February 20 put was actually trading at $1.50. And if you take a look at that put pricing, you would note that if you subtract $1.50 from $20, you actually get an answer of $18.50, which it suddenly looks like there might be some sort of mispricing here. But VIX options and RVX options and all the volatility-related options actually share this pricing characteristic, and we sort of expected it to look like this when we started trading RVX options, and I'll be darned if they did not trade exactly as we had anticipated pricing-wise. The February future, which is what I would consider the best or probably the easiest underlying pricing vehicle for RVX options, should be used to value out that option contract. Now, as always, if you think that the RVX, the Russell Volatility Index, is going to settle close to where it's trading on this day in December, you could actually think about buying that put option and would end up with a small profit if we settled at 1783. It's one of the unusual things about options, and specifically put options, that trade on volatility indexes. Now, early on, we actually saw a trade back in December. We'd only had options out for a few weeks, and we saw somebody come in and actually put on a bear put spread. They paid 35 cents for it, and that did not include commissions. They were expecting, and your expectation on this trade, and we'll see it in a payoff diagram in just a second, but the expectation on this trade, where you would buy 50 of the RVX 18 puts for 58 cents and sell 50 of the RVX 17 puts for 23 cents, your expectation here is that RVX will settle at 17 or lower at expiration. Here is the typical payoff diagram for a bearish vertical spread, in this case a bear put spread. And just to give you an idea of some of the pricing characteristics here, the Russell Volatility Index on this date was at 1850, and when they executed this trade, the futures contract, the corresponding January futures contract, was actually trading at 20. The expectation again was hopefully for February expiration to be somewhere under 17, expecting a drop in volatility into February expiration. And actually anywhere below 1765, you would have ended up with, between 1765 and 17, you would actually end up with a small partial profit. Anywhere between 1765 and 18, you would actually end up with a loss, but a loss that is less than the maximum loss of 35 cents. And this is just spelling out, I wanted to leave the diagram up as I went through these levels, but again, if RVX settles over 18, we're out 35 cents for the premium that we paid for the spread. We have a partial gain or loss. That break-even level was 1765. And then finally, this is what we're shooting for right here. RVX settlement under 17, and we end up with a 65-cent per contract gain. And these are cash-settled option contracts, so if RVX settlement is down below 17, you can just let those options expire, and the position is gone, and the profit is in your account on Monday morning. Then you can take a look at another bearish volatility spread or another trade based on whatever your outlook happens to be. So Russell 2000 Volatility Index, it's more volatile than the VIX. It moves somewhat in sync, but does get out of line with VIX. So there appear to be opportunities there every once in a while. And if you're more concerned about the U.S. economy versus the global economy going forward, it's actually an area where you can gain volatility exposure that is much more domestically influenced than globally influenced, like VIX. One last volatility index, we only trade futures on VXN. VXN is typically at a premium to VIX. There's somewhat of a seasonal pattern, and I'm still doing some work on how this shows up in the futures contracts, but there is a seasonal pattern related to VXN, and what it really does, what it really boils down to is earnings season. The NASDAQ 100 Volatility Index is heavily influenced by just a handful of stocks. And at one time, I think Apple was over 20% of the NASDAQ 100 Volatility Index. So you would get more of an anticipatory pricing in VXN as opposed to VIX or maybe even RVX. Because of some single stock influences there. I would also, what I've picked up on is a little bit of seasonality related to VXN and VIX around earnings, where VXN might be at a little bit of a premium going into earnings, and that premium may dissipate coming out of earnings. What I really want to do is work on the appropriate VXN futures versus VIX and see if the futures are adjusting for this or not. And because VXN trading's only been around for a few earnings seasons, I'm still the jury is still out on how I think that's going to work out. So VXN does the same thing relative to its index as RVX and VIX. You tend to see that inverse relationship. It's not as great an inverse relationship because of that anticipation of a big move around earnings that shows up every once in a while. It's part of where I get that theory from. This is what the VXN futures pricing looked like back in September. And you can see we've got that same situation where where two of the futures are not at, the November future is only at a 30-cent discount relative to the December future. November's at 18.90 and December's at 19.20. If you move forward, you can see that by November we've actually got the November contract at a discount of about a point, and actually the curve's even flattening, and you've got November at a discount of about a point. Typically, if I have an expectation that there's going to be a quiet volatility market, one of the trades that I might consider doing is actually taking a look at, and in fact, VXN had gone down some, but I would take a look at shorting, a nearer month future and going long a farther month future. Get a little bit of protection against some sort of volatility event, but you basically benefit from these two futures contracts kind of working their way down the curve, for lack of a better way to describe that. And as you can see, about how much time is there? About 8 weeks later, we've gone from a 30-cent discount to a $1 discount. So the VXN, it behaves very similar to VIX. The shape of the curve varies with the outlook for volatility, based on what's going on with NDX option pricing. I do think, just from observation, and I'm still trying to quantify it, that there is a little bit more seasonality oriented with VXN as opposed to VIX, because the NASDAQ 100 index is influenced by a handful of large cap stocks or large cap technology stocks. Across the board, we have almost 30 volatility indexes that we are quoting real time here. The ones that I've shown today are the U.S. equity market indexes that have trading available. We're seeing, I've I'm a big proponent of pair trading or spread trading, so I'm consistently looking at the relationship between VIX, VXN, and RVX, and just trying to get a feel for, if there are recurring patterns, if I feel like, one area's volatility is overpriced relative to another area's, or vice versa. I'm just constantly doing work on that, and as we get more futures data, as we get more, as more days under our belt with RVX, VXN, and VIX futures all trading at the same time, the more I will actually be able to come back to you with as far as these areas go. So with that, there is my contact information. If you have any interest in any of the volatility indexes, the link is cboe.com/volatility. I am also associated with the CBOE Futures Exchange, and if you want to find out anything about the futures contracts, that's the link right there. And then I did mention that we're going to be talking about VIX and SPX in New York, San Jose, and Chicago, and I'm going to put up the easiest way to find that, not seminary, seminars. So 4-2 in New York, 4-8 in San Jose, and 4-10 in Chicago. So I heard you.
Ah, yes. I have snuck back in the background. But I would like to invite any questions you might have for Russell. Enter them into the chat panel, and he'll be happy to answer them. Now, while I am waiting for any additional questions to come in, I also have a piece of business that I need to run during each of my events, and that's a quick poll. Now, the poll is only going to be open for about 30 seconds, and it is a requirement from IB's management. We'd like to get your feedback. And notice I've just opened it up on your screen. There are 3 short questions and 2 are multiple choice, so please make your selections and then use that submit button in the lower right-hand corner. Now also, number 2 has an input field. That's not where to put questions for Russell. He won't see those. Hold those for your chat panel, but it does make a great spot if you've got some comments or suggestions on other topics that you'd like to hear more about in these webinars. Poll's about to end, so everyone please finish up and click that submit button. By the way, if you do have any suggestions or comments you'd like to know about, because that poll did end very quickly, you can always send those to me at webinars@interactivebrokers.com. Okay, thank you, everyone. Very helpful with that poll. But I'd like to turn it back over to Russell now because I see some questions have come in. So Russell, and by the way, you can close that polling panel using the X that's included in the title bar, and then simply double-click the chat panel title bar to expand so that you can send any questions there as well. So back to you, Russell.
Okay. Let's see. Yaroslav is asking, do I have a correlation of VIX, RVX, and VXN? I do, but I don't have it in front of me. They're in the upper 90s to mid 90s, depending on which one you're actually looking at. I think VXN might diverge a little bit more, but I would have to pull those numbers. Again, now you owe me an email for 2 things, and I'll send you the spreadsheet where I actually have that. Carp was asking, why do I prefer RVX and RUT over VIX and SPX? Because that is a terrible joke, and that is my name. So it actually is because, Russell 2000 is, that's why. Every time, there you go, Carp. I'm glad that you smile and you're playing along a little bit. Every time there's a trading conference, I come back to my office and I have lots of Russell Index hats and pads and Frisbees, and everybody thinks that's funny. Jason is asking, why have we not seen much contango in the futures curve lately? Jason, we've seen contango, but it's not as steep as it used to be. And I actually think, and this comes from my discussions with professional traders, there's this trade right here. I'm trying to think of a good example to show. This trade right here. where you've got the curve and you're taking a look at maybe selling this future and buying the 1920 future, but maybe doing it farther along the curve. What you're actually seeing is I think this is becoming a little bit more of a crowded trade. And you get some traders that, because it's a crowded trade, you start to get a bigger discount on this end of the curve than we've seen in the past, and it translates to a little bit less of a discount on this of the curve right here, on this end of the curve right here. I also, contango basically exists because the seller of this September, the September VXN future in this case is receiving a risk premium for being short volatility. Well, since we haven't had VIX above, I believe, 21 or 22 since August of 2011, or above the low 20s, the risk premium for being short volatility has shrunk. And that the more narrow that this risk premium that you would get for selling this September future or even this October future has resulted in less of a difference between the index and the futures contract. It's become somewhat of a crowded trade where you're seeing people trying to play the curve because it seems to have held up for some time now. When we do have volatility events where we've got a quick run up in VIX, what you've actually seen, and unfortunately I don't have one of these, so I'm going to try to draw, what we're actually seeing more of is something that looks like this, and it will look like this to September, this to October, and then back up. And it almost looks like, instead of going into full backwardation, which is what we used to see, and I'll draw backwardation on here, what we used to see was something that looked more like this when we would have a spike in volatility. Isn't that beautiful? So we used to see, the front month future would go up somewhat. Now what we're seeing is that VIX will go up, and the move that we'll have will be off of something like what we see here on the blue line, where VIX moves up. Maybe maybe I didn't do enough justice for the front month future. Maybe it should be more like, I'll try to. This is why I don't draw on these things. Might look more like this. Let's say that we have a volatility event and we close at 1632 and 1725, and on the volatility event day we go up like this. The next day the curve might look something like this, where it kind of curves down and then comes back up. Where the front month goes up, the next month goes up, and we don't get much of a reaction on the longer end of the curve. And because of this sort of price behavior where there's a lot of activity in the front months, and the front months are the only months that are reacting, we're not ending up in backwardation, but I also think that's a function of a lack of contango. The fear, and this comes from our risk management conference, and this was actually said on stage by one of the market makers in VIX. He basically said that we keep getting these small spikes in volatility, and the front month future will go up a little bit, but there's not a whole lot of panic to these things. And his thinking is that when we get a two-legged volatility spike, like we get a move up to, let's say 19, and then the next move on this chart is up to 24 or 25, that you will see real backwardation again. But the low volatility environment and the lack of any follow-through from volatility to the upside is resulting in different shapes of the curve that we have than relative to what we've seen for the last 5 or 6 years. So that's probably more than you really wanted to hear about contango and backwardation, but that's what's different now. And you asked about what's up recently, and that was the explanation that I heard more than once at our risk management conference last week. So thank you. You know what? Thank you, Jason, for saying that. Sometimes I wonder if it's coming across. Somebody said that RVX is just leveraged VIX. The Russell 2000 is more volatile than VIX, and RVX is more volatile than VIX as well. So saying that RVX is leveraged VIX, I can't argue with that, but saying it is just leveraged VIX, I don't think that is a correct point. It's more of a measure of a smaller areas, smaller geographic areas volatility, or just the U.S. market volatility. It's a measure of volatility on more volatile stocks, and that's why it is consistently at a premium to VIX. But there is enough of a disconnect. If the correlation was like 0.98 or 0.99, I would, and if the correlation was 0.99 or 0.98, 0.99, and that was the correlation between the Russell 2000 and the S&P 500, I would totally agree. But the correlation is closer to 0.9, so there's enough of a difference in there that I think calling it just leveraged VIX is too much of a simplification. I think it is leveraged VIX and its domestic volatility and its its volatility exposure to a different macroeconomic environment as well. So I think there's more to it than just being leveraged VIX. I have not heard that statement before either, so I'm glad to have heard that. That's why I like doing Interactive Brokers webcasts. I always get really good, challenging, and thought-provoking questions. And I like Cynthia.
And here I am in the background, already unmuted. What I do want to do, because actually that was an excellent segue into letting everyone know that you have, just recently, we have mapped out all of the webinars, monthly webinars with Russell through the end of the year. Actually have one coming up, and by the way, they will be, and I think we've stuck pretty well to it, the Wednesday ahead of Option Expiration Friday each month. So do be on the lookout for those events. They're listed on IB's education, or under IB's education menu. There's a webinar section, and all of Russell's events will be listed underneath the industry-sponsored titles. Now, you can filter at the top of the page by sponsor or by speaker and find isolated just the ones for Russell. Coming up on April 16th is short-term trading with weekly index options. Well, so everyone did want to let you know that it is out there, and if you register and cannot join us live, we're going to send everyone a copy to that recording link. So if you have an interest, simply register for the event, and we'll send follow-up, we'll send reminder messages as well as post-event follow-ups with the recording link and the webinar notes. So it looks like, Russell, we are going to conclude our March event, and wow, ready for spring here. Thank you very much for today's topic, and good luck to you on your cross-country tour. Lots of traveling ahead for you.
Yeah.
Well, thank you, everyone, for joining us today. And do you have a link to that information, Russell? If you can pass along to me what your schedule will be, I'll be happy to include that with the event follow-ups. So,
oh, sure. I'll shoot you an email right now.
That'd be great. And so everyone, I'll include that with the recording link. It normally takes me about an hour to compile and upload it, and as soon as it's available on our servers, you'll get a direct link. So thanks, everyone. Have a great afternoon, everybody, and please remember to trade smart. Especially thank you, Russell, and the CBOE for making today's presentation possible. Until next month, we'll talk to you then. Thanks, everybody. Have a great day.